Hello everyone and welcome to the Rapport webinar. Firstly, I want to wish everyone a happy new year and thank you for joining us. And this is our third webinar that we're holding on a quarterly basis. So we introduced them in July last year, and the idea is fewfold. We want to increase our conversation that we're having with our partners, and this is one way to do that. And we want to, and we feel it's an opportunity to give our perspective of what's happening in the diamond market from our point of view. We're gathering information through our market intelligence at our various offices around the world, we also have a very powerful tool in RapNet that provides us with some interesting data, and we spend a lot of time looking at that data. And presenting it to the market through primarily our Rapport research report, which we launched a year ago, and we're going to be publishing our next edition tomorrow, in fact. So a lot of the data that and market analysis that we're collecting is based on trends and pricing information that we see on RapNet. And this is an opportunity to present it in an informal way and to increase the conversation with our partners in the market. So thank you for joining us. The structure of the webinar will be that I'll speak for about half an hour to 40 minutes, and then we'll open up the forum to written questions. So if you have any questions, you should submit them to the Q&A. The button on the Q&A tool at the bottom of your screen, and we'll read those off at the end of after my presentation, and try and give some insight into how we're seeing the market from those questions. With me in the room is David Ehrlich, who's our product manager, our operations manager, who's helping with some of the technical aspects of the webinar, and also Shimon Gerstensang, who heads our pricing research team, who will help me with some of the insights on pricing if you have any questions that I stumble upon. So let's get started, and again, thanks for joining the webinar. So the goal of the webinar is, it's a new year, and it's an opportunity to assess the performance of the diamond market in 2018. And primarily we'll do that through some of the pricing information that we have, especially through our RAPI index, the RapNet Diamond Index, which presents some picture of the market in terms of polished prices. All the pricing information we present today is from a polished point of view. Then we're going to be looking at some of the macro issues that are influencing the market. In our promo, we mentioned the three aspects that are affecting diamond trading at the moment, and certainly in the second half of 2018, being China, credit and liquidity in India, and supply issues which have taken effect. And then we're going to look at some of the data that we present in the research reports based on the January report that's coming out tomorrow, that will present some context of how we're seeing the markets from a data point of view. So as a whole, when we look at 2018, it was actually a relatively good year for the diamond industry. Our flagship RAPI index for 1-carat diamonds finished the year in positive territory for the first time since 2011. So the 1-carat RAPI was up by about 0.7% for the year. And then we had varying trends in the other sizes. The 30-pointers and the half-caraters had a real up and down year, with the half-caraters also ending the year in positive territory, but the 30-pointers ending in negative, and 3-caraters also down for the year. And as I mentioned, in fact, for the hot market as a whole, it was really a year of two halves, to avoid any cliches. But the one-carat RAPI we saw in the first quarter and the second quarter were positive. That they were up 2.8% and 0.6% in the first and second quarters, respectively. And then there was a slowdown in the second half with the index down 1.1% in the third quarter and 1.5% in the second quarter. And we see that overall the index was a stronger performer than it was in previous years. So when we look at specific categories of diamonds, across colors and clarities, the one-carat RAPI outperformed itself from previous years in all those qualities. So taking specifics in this graph, if we look at the D color IF clarity diamonds, they were slightly down for the year. F VVS2 were slightly up for the year, but fairly stable on both those categories. But again, in each of the previous 4 or 5 years, there were quite significant declines in those categories. And then we saw some nice improvements in prices for HVS2 was up around 8% on the one-caraters. That we saw. This is all based on RAPnet prices, and KSI2s were up about 5% for the year. And so when we look at the market in context of the last decade, really, we like to show this graph that it really is. There was some stability in the market in 2018 for the one-caraters. But overall, there's been a longer-term correction that we continue to be in, and the question is the question really is if the stability in 2018 is a sign that we're moving out of that correction mode, or if it's really a continuation of it. This graph shows the RAPI index for one-carat on a downtrend from 2011. That was a bit of a bubble year, if you remember correctly. But we really see this correction as a correction from the 2008 crisis, where the diamond industry has had to readjust on a number of fronts. And I spoke quite extensively in our July webinar about some of the positive things that the trade is doing that'll help us get out of that correction. And I was quite optimistic at that point, given some of the programs that are going on in the trade to improve customer engagement and various other things that I believe will support polished prices. But 6 months later, it's showing a bit of a more cautious environment. And if we're talking about the year being a year of two halves, the first half of 2008 was really supported by strong markets and strong restocking of goods after the good holiday season in 2017 in the United States, and also a good Chinese New Year season around this time last year. So the beginning of 2018 certainly had a lot more optimism about the market than we saw towards the end of the year, and the second half of the year painted a bit of a different picture. When we published in January in our Rappaport magazine, we published our annual pricing report, which presents 40 years of diamond pricing data. 2018, we celebrated at Rappaport 40 years of publishing the price list. And so we're able to tap into all that data and see some interesting trends that have evolved over those 40 years. So we published that in our magazine. I encourage everyone to get a copy of that magazine or to see the report on through our store. But one of the things we like to look at in that report is how various asset classes have performed over the last 10 years and compare diamonds to those. You know, a lot of people ask me if diamonds are a good investment, and my gut reaction is that yes, they are a good investment because they're a good store of value, and that is true, I believe. But if you put $1,000 in various asset classes at the beginning of 2009 and watch their performance over the next 10 years, the value, if you put it in a 1-carat wrappy, the value of your investment will be $858. So you would have lost a bit on the investment, and certainly diamonds underperformed other asset classes, particularly the stock markets. Gold was the best performer amongst the commodities that we included in this little exercise. So the question is where is the momentum? Like I said, the first half of the year was very positive, and we were sort of predicting that the uptrend was sustainable. But then the second half of the year was quite negative. So we're going to spend a bit of time looking at some of the macro issues that are affecting the market and see where the momentum might be going in terms of diamond pricing. Excuse me. So let's start with the positives, and I spoke a lot about this in our July webinar. I'm very encouraged by some of the trends that we're seeing both amongst jewelers and diamantaires in engaging with consumers in a more proactive way. And I really do believe that this feeds into supporting polished prices at the end of the day. There are more effective omni-channel programs out there that retailers are developing platforms that combine their online activity with their in-store activity. They're making the shopping experience more interesting and sexy and fun and luxurious, both online and in-store, and that's highly important in today's retail environment. And they're realizing that you can sell diamonds and diamond jewelry online, which it took a while to come to that realization. And so we're seeing growth in online sales, and certainly growth in using online sales to push customers to the stores and engage with them in an interactive way. People are using social media more effectively and in more interesting way, and there's some interesting marketing programs that are going on. And probably most importantly, there's a very serious discussion about responsible sourcing in the diamond industry that is both necessary and it's just necessary and effective to drive sales and support polished prices at the end of the day. Consumers want to know that their product is ethically sourced, and more than that, with the expected increase in lab-grown diamond demand, the responsible sourcing story, being able to show where your diamond is coming from and that it's traced through the pipeline in a responsible way, is important to counter that, important and effective way to counter that negative narrative that this lab-grown diamond industry is telling about the natural diamond product. So these are encouraging developments, and I really do believe play a role in supporting demand and ultimately polished diamond prices. But we have a few areas of concern, as we mentioned earlier. I've added one area of concern to this being the US market, and I think, as I said earlier, the 2019 is starting on a more cautious note in terms of consumer confidence than we had in 2018. The holiday, the initial the reports we're getting about the holiday season from the majors were somewhat disappointing. And we're in the middle of a government shutdown. Stock markets were volatile in December and continue to be in January. And we're working in an environment with higher interest rates, and all this is feeding into a more cautious sentiment amongst consumers. Overall, I think we will see slighter growth from the holiday season, but as I said, the consumer sentiment seems to be a little bit less optimistic, let's say. But looking back at 2018, the big stories that there were certain themes that affected sentiment both on a consumer level globally and also within the trade. And certainly the tensions that evolved between the United States and China regarding increased import tariffs to the respective countries had an effect on injecting some uncertainty to the market. In China, stock markets fell in 2018, and that had an effect of a negative wealth effect. So people felt less wealthy and less inclined to spend as freely as they did on discretionary items like diamond jewelry. Certainly, it has at least a psychological effect on the trade and on consumers. And secondly, the yuan renminbi currency depreciated by nearly 6% throughout the year, and this makes products more expensive in China. As jewelers import many of their materials, they're paying for diamond inventory in dollars and selling in their local currency, and so they need to raise prices. So they need to raise prices to make up the difference in the currency play. And probably more importantly and more apparent is that it reduces tourist spending in markets such as Hong Kong and in certain stores in New York, London, and Paris, which rely on Chinese tourist traffic. We had a bit of a giggle in the office when we looked at this graph. I was trying to make sense of the 30 pointers, looking at the RAPI price movement through the year, and we saw this very sharp increase in the first half of the year. And the 30 pointers are very much a Chinese item. They're a popular item in the Far East. And then we saw a sharper drop-off in the second half of the year. And I looked at the peak. When did the RAPI peak? And it was around July 6th to the 9th. And we were discussing, what happened in that period. And we looked through the news sources, and July 6th was the date that the United States implemented its first China-specific import tariff increases, which were, whether it's a coincidence or not, I think what it does tell us, this graph does tell us in that context, that at least from a sentiment point of view, there is the tensions were part of the discussion in the trade and injected some caution in the market for 30 pointers at least, and other sizes. I don't think we can say that the trade war caused diamond prices to fall directly, but it was one of the contributing factors. The blue line on the graph that you see in front of you is the currency trend, and we see around the same time that there was a sharper depreciation of the renminbi against the dollar, which would also have fed into the softening of diamond prices. There were other factors at play, though, and we mentioned that in the first half of the year there was an optimistic view about Chinese jewelry retail sales, and after a good Chinese New Year, and we saw that there was stronger demand for goods from the East by jewelry retailers in the region. And this graph shows the inventory, the reported inventory, which includes gold products, watches, other gem set jewelry, but certainly diamonds is a significant part of that inventory. At Chow Tai Fook and Luk Fook, which are two of the major Hong Kong-based retailers with strong activity in mainland China as well. And we see that their inventory, that they did a lot of inventory buying in the first half of the year, and at September 2018, their inventory levels were at certainly a high point compared to the last 2 or 3 years. And after that, so there was a feeling in the market that inventory levels were high at a retail level in the East, and that they weren't as active in the diamond market looking for goods as they were at the beginning of the year. And so came the fourth quarter of the calendar year. In the fourth quarter of 2018, we saw some slowdown in the sales that were reported about the region. Chow Tai Fook and Luk Fook same-store sales dropped off. Chow Tai Fook by 7% and 6% in China and Hong Kong. Luk Fook also saw declines in both China and Hong Kong. And we saw the higher end jewelers operating in the region, such as Richemont, which owns Cartier, and Van Cleef & Arpels, and Tiffany & Co., noted a drop-off in tourist spending over the holiday season, not only in Hong Kong, but also in, for example, Tiffany's store in New York. What both of those higher-end companies mentioned, though, was that there was strength in mainland China, and that's very encouraging. That there seems that while tourist spending seems to be softening, I think largely because of the currency play, there seems to be a shift towards, certainly on the higher end luxury market, towards spending more in China, and that's been a goal of Premier Xi Jinping for some time since he came to power. So at the same time, we saw pressure on the Indian trade from a number of angles. And I'm going to spend a few minutes just going through what's happening in India in 2018 and where we stand now. So the first aspect was that the rupee depreciated by 10 to 12% across the year, and it was quite volatile at the same time. It wasn't a gradual increase. We saw, especially in the fourth quarter, some ups and downs, and that volatility plays into uncertainty amongst businesses operating in the export arena. Actually, a weaker currency helps the larger exporters. With the Indian diamond industry is driven by larger manufacturers who are exporting a lot of goods, and so if they're selling their diamonds in dollars and paying some of the expenses such as labor and other local expenses in rupee, they're getting more rupee for their dollar, and so it alleviates some of the pressure on their local costs. It also raises prices, as we mentioned in China. It raises prices in the local markets, and we saw that effect of weaker demand for very small diamonds in India in 2018. But probably most importantly, it has an effect on bank credit to the Indian market, and as credit lines are based in rupee, and so as the rupee depreciated, the dollar amount of the loans that they were getting in rupee diminished, and so credit lines, just on a pure currency play, were reduced in 2018. The issue of the Rapport research report that we're publishing tomorrow deals with this new reality of this new banking reality facing the Indian market, and so it's not only a rupee play, but we're also seeing much more caution amongst the bankers lending to the industry, And that is one aspect that we expect is having an effect on the market and will have an effect on rough buying, at least in the years ahead. So while there was this rupee story going on, and the industry was also facing softer demand, particularly in the second half of the year. And when we look at India's polished exports, firstly, it's important to understand that India is the main manufacturing sector for the diamond industry. So an estimated 14 out of 15 diamonds are manufactured in India. So when we look at their polished exports, it gives us a good picture of what's going on in terms of demand, in terms of global demand. And we see the blue bar lines in this graph are showing the volume of polished exports from India. And there, and we see that the volume declined in 2018 and was at a low for the decade, really. At the same time, the value of exports was increased. And so what that tells us is that India was getting fewer orders, but there was a shift to higher value diamonds that affected this interaction between volume and value. At the same time, India's rough imports, importing rough to manufacture, rough imports declined in 2018 as they were expected to, but it's important to note that 2017 was a peak year for rough diamond production at a mining level. And a lot of those goods were sent to India for manufacturing, and so we expected a bit of a drop off in imports in 2018, but in the context of the last decade, imports were still quite high, and barring 2017, it was at a high point in last year compared to the last decade. As I mentioned, that's really because of global rough production. That's in 2017, there were 3 new significant mines that came on stream, and so there was an expected spike in rough production from the mining companies, and that higher level of production continued in 2018. The important point here is that all that rough inventory is not sitting at a mining level, and if we go back to the India's rough imports, we see that the midstream is absorbing a lot of that rough, and that's putting a lot of pressure on the manufacturing sector, because going back to India's polished exports, the polished exports are not increasing at the same rate. In fact, they came down in 2018. So from that trading perspective and the interaction between rough supply and polished demand, the midstream is being pressured by absorbing a lot of inventory, and that's where the supply issue comes in. And we're seeing that we're seeing a lot of that supply has ballooned in 2018, and that the midstream cannot necessarily absorb all the goods that came to the market during the year. So this graph shows polished inventory on RapNet. So that's total inventory across all categories of RAP Spec A3 and better stones. And we see that compared to the beginning of 2018 to today, the inventory, the number of stones on RapNet are about 24% higher than they were a year ago. We see from this graph that there was a bit of a drop off in January, which is somewhat expected after the holiday season. But even with that drop off, the amount of polished on RapNet is significantly higher than it was a year ago, and even at peak periods during 2017. And just to recap what is influencing that increase in inventory, we're seeing that that Far East jewelers stopped or weren't active in the market in the second half of the year. We're seeing much more prudent inventory management amongst US jewelers. They're taking more goods on memo. They'd rather have supply sit at their suppliers, because through their interactive retail experience that they're providing to customers, they can show them their inventory through a laptop, rather than having to physically hold it in the store. So they're holding fewer goods in the store, and then mining production is at 10-year highs, and so all that dynamic between the retail and the rough means that polished inventory is shifted to the midstream and being stuck in the midstream. So when we publish the Rapport research report, we're providing pricing data that tells a bit of this picture. We're showing from a supply side what price movements are happening in specific categories of goods. We're showing the change in inventory at the beginning of the month compared to the average of the previous 3 months, and we're showing discounts. And then on the demand side, we're able to show what people are searching for, the rate of sales, the rate of goods that are going through RapNet, and the actual sales that are occurring with a bit of a time lag, because we have to assess the movement of goods on RapNet. So this is a snapshot from the January price report the January research report for 1-carat diamonds. Generally, the 1-caraters are showing a bit of a more stable picture than the smaller goods. And we're seeing that in the inventory movement, that there was a bit of a drop off on certain categories in January compared to the previous year. But having published the research report over the last year, we started in January 2018. If you look back at our reports from a year ago and compare that inventory, you will see that inventory levels are significantly higher, and that's had an effect on prices. So when we look at at 1-caraters, and this is data that's been collated from the research report, we see that that inventory is over the last year, and this is to November 2018, and because that's the latest month, we can show sales. So inventory in November dropped off a little bit because before the holiday season, but sales but were still higher than a year earlier. Sales, in the meantime, had dropped off through the year, even though they were relatively stable. And so when we compare sales to the amount of inventory that's on RapNet, we are able to come up with a ratio that we look at to assess whether the activity in the market. And we see in November 2018 that 27% of goods on RapNet were sold into the market, essentially. So it was a relatively low percentage, which was partly explained by the Indian market being closed for Diwali. In November is a Diwali festival, and there's less activity in India. But even compared to previous Diwalis, it was a relatively low month of sales versus inventory. This is how these tables are how the demand side of the market is presented in the research report through grids on various colors and clarities for 1-caraters. We're presenting inventory volume and sales volume and price discounts for those goods. But when we look at the data on RepNet, we really are looking for anomalies and trying to understand from our market intelligence where those why those anomalies are happening. And we found one such anomaly in the 30 pointers in the January data, because if you look at this this table carefully when you get the report tomorrow, you'll see that inventory came down, particularly in the SIs. If you look in the SI column, from D color through to K color, inventory came down compared to in January compared to the previous 3 months, but prices also came down. So when inventory comes down, you would expect that if supply is coming down, you would expect that that would support prices in some way, and we didn't see that in this category of goods in the most recent months. So let's look at the 30 pointers D to K color SIs. And this is the inventory, the number of stones that are on RepNet. As you see, they did drop off a bit in January, but are still quite high in the context of the last year. So particularly compared to a year ago, they're almost 3 times the amount of goods on RepNet that's in this category, even though there was a reduction compared to November, December. So we see that inventory has increased in the last month. When we want to assess the rate of sales of this category of goods, we want to look at we have data until November, and we see how inventory increased quite sharply of that category, but sales were relatively weak. And so the result is that sales as a percentage of inventory slumped in November to 13%, which was certainly a 2-year low, but I would imagine that you won't find such a low number going further back. Again, November was a Diwali month, so the Indian market was on holiday, but in the context of previous Diwalis, this was an extremely low month. So when we look at such a slow number, we start to understand why since November, prices have continued to soften. And we see that dynamic in the RAPI index, in RepNet prices, that if this is the rate of sales, sales versus the inventory that's available, it was on a constant decline in the second half of the year. The momentum in sales price has continued to go down. And so that's what we're seeing in the 30 pointers at the moment, and to a lesser extent across the market in other categories as well. And so what do we take from that dynamic? The first is that and this is not only from the data, but in talking to people in the trade, we really get a sense that people are not comfortable with the current inventory levels of polished in certain categories. And certainly there's a high volume of goods that are of lower quality goods, perhaps, that are in less demand. But people are not comfortable with current inventory levels, and if Indian manufacturers are facing lower bank access to credit, as other markets are, there is a feeling that they're agreeing to sell below their price expectation. They want to reduce some of that inventory so that they can raise their liquidity. And the bottom line is that buyers are really setting the tone in the market. Buyers are not looking for buyers are quite selective in the goods that they need and are willing to hold themselves, but the market is there for their taking. And just finally, a word on the rough markets, that we're looking very closely at how this is going to play out in the rough market. And the big question is if the market can absorb the high volumes of rough that that we've seen in the last 2 months, the last 2 years, if that's going to continue in 2019, and at what price levels. And my feeling is that that manufacturers are at some point in 2019 going to draw a line and certainly stop buying rough at current price levels, because they need to improve their profitability on a number of levels. So that's my little summary of the market. Thanks for listening. And if you have any questions that you don't want to present in the Q&A section, you're welcome to email me, avi.krawitz@diamonds.net. I'm also on Twitter. My Twitter handle is @avikrawitz. I would encourage you to firstly look at the January edition of the Rapport magazine, where you have 40 years of diamond data at your fingertips. If you don't have the magazine, if you're not subscribed to the magazine, it is available on our store, along with subscription to the research reports, which tells a picture in itself about the market on a long term. So I'm going to open the webinar up to your questions. If you have any questions, please submit them in the Q&A section, and I'll do my best to give my perspective on that. So our first question is from. I won't mention the names of the people who are asking the questions, because I'm not sure if everyone's comfortable with that. But our first question reads: how will the market be affected by the increase of popularity of synthetic diamonds, and how will it affect the major market players? So yeah, synthetic diamonds, or lab-grown diamonds, are the buzzword. Certainly in 2018 was a year when they became more acceptable to the market. We expect there will be an increase in demand for these goods, but it really is a question of the diamond industry being more confident in its own product. And I think if the conversation has been about disclosure issues until now, and worrying about the effect of undisclosed synthetics being mixed in with goods, with natural diamond goods, the conversation is really shifting now to differentiation. You know, how do we differentiate our natural product from synthetics? So look, synthetics is going to increase in demand. It will have an effect on the smaller goods. I don't think it'll have an effect on pricing as yet in 2019 in a very significant way. I think that with De Beers in the market, it has given a green light for others to enter the space. And I think that De Beers is setting a standard price will help differentiate certain categories of synthetic diamonds, but I think it won't necessarily differentiate the better quality, larger goods. And I think we might, I think that's where a bit of an unknown is that the industry needs to really focus on branding, telling its story to differentiate from those goods. I think that we will see one or two of the major jewelry retailers taking synthetics on board, if not in 2019, in 2020, and that will really it'll be interesting to see how they incorporate that to the market. Already, some of the more important jewelers are selling synthetic diamonds, but that differentiation is very important. So yeah, there are a lot of questions about synthetics. What is my opinion about Lightbox? I think we pretty much covered that with. I think the question is on the long term, and I don't see the other aspect of synthetics is that there is an investment in production that we're seeing in the synthetics market. De Beers is developing a new facility in the United States for its Lightbox line. The Diamond Foundry is ramping up its production of lab-grown diamonds. They expect 1 million carats of rough a year to go through their facility from next year, and there's a lot of interest in this market. So so it'll be interesting to see how it evolves. So something doesn't add up. Rough imports into India are lower in 2000 and, oh, sorry, I lost that. Rough imports to India are lower in 2018 than 2017. Chinese retailers increased stock in the first half of 2018. So why is there higher levels of goods on RapNet in 2018 than in 2017? If there is less rough coming into the pipeline, a buildup of inventory in China and global diamond retail is stable. So why is inventory building up in RapNet? Well, I think there was too much rough that came into the market in 2017. I don't think that was absorbed at a retail level, and so that inventory was built was stuck in the midstream. I think. Yeah, the inventory play. Look, there's another aspect to the inventory buildup in the midstream, is that the midstream also needs stock. They particularly as retailers in the United States are relying more on memo. So they need it to be an effective memo house. You need high volumes of goods, and they're holding less goods in their stores with a move to through technology. They're having access to stock on a faster basis. So if they can place those orders on a more needs basis, they need less goods in their stores. So but I think to answer the question, in 2017 there was simply too much rough that was bought by manufacturers, and it's one thing for the miners to mine the rough, it's another for manufacturers to buy the rough, and there is a feeling that there is an overhang of goods from that year that's continued in 2018, and they continued to buy as we saw in those graphs. Okay, so our next question. What do I think about Tiffany's declaration that they will specify the origin of every diamond they sell above 0.18 carats? Firstly, it's a very important development. It's not entirely surprising. We know that the major jewelers, Signet Jewelers, and we know that Tiffany has been looking at these traceability programs for some time. We know that Signet has a protocol of Signet being the parent company of K Jewelers and Zales and Jared and other brands. That they've been looking at developing programs to work with suppliers to ensure that they know their suppliers, and they know their suppliers' suppliers, and that they can account for the diamonds that are passed through the supply chain, and that conversation extended to the trade in a very big way in the last 2 years, with various blockchain platforms aiming to show that traceability, at least on the transactions, and some other interesting programs that are tracing the physical diamond from mine through manufacturing to the retail store. When a company like Tiffany has a high profile company like Tiffany makes such a declaration, it garners a lot of interest, and it provides very positive publicity for the diamond and jewelry industry as a whole, that it tells us this is a trend, that if Tiffany is doing it, we want others to follow, and hopefully it'll set a standard. As I said, it's one area that the natural diamond industry can counter the threat of synthetic diamonds, both in terms of its synthetic diamonds gaining its market share, but the synthetic diamond companies are marketing themselves with a very, very negative message towards the natural diamond market. So these programs are highly important to counter that negative messaging, because it not only shows that the diamonds are accountable, but it also shows that diamonds are doing good for the world. You know, that millions upon millions of people rely on natural diamond industry for their we'll put it this way, the natural diamond industry is sustaining millions, tens of millions of people across the world, and some of them the poorest people in the world. So I applaud the move by Tiffany. So what is my opinion on global rough supply over the next couple of years? It's a good question. The new major mines that have been in development came on stream in 2017. That being particularly Gachakwe, and so there's some interesting projects in Angola that we're hearing about, and one or two in Russia might come on stream in the coming year or two, or in the coming decade, let's say. But a lot of the major mines that have been sustaining the industry are in the latter end of their lifespan. Argyle particularly comes to mind, and so if Argyle, Rio Tinto's production was around 18 million, I think it was in 2018. I need to double check that number, and so Argyle was a good proportion of that. It's a 13-14 million carat mine, and that's going to come. The Rio Tinto has announced its closure around 2021 or 22, and so we are seeing that a lot of the mines that are sustaining the industry have a up to a 10-year lifespan. So I think that as it stands with current production, mining production has peaked for the next decade at least, and it'll take a big find to boost that. I think that the criteria to develop a diamond mine has increased. So companies there is a higher criteria to make that decision to develop a mine. So I think that we were discussing it today actually in our news meeting, because we had a story about one of the exploration companies that's been around for a long time, that raised money to sustain its operations. We didn't cover the story, but the discussion was around whether we're going to see fewer of these pure play exploration companies, if it's really worth their while to look for to embark on these greenfield projects. And I'm not sure, but it's certainly, it seems that that unless it's a really good project and clearly visibly viable, that there are not too many of those around. So there is going to be a drop in supply over the next decade or two, and that should support prices, but really the rough market has evolved on a more of a short-term level, in the last decade at least. You know, we've always spoken about this this shortage of supply, and we haven't really seen a shortage of rough supply in the last decade. But we'll have to see how that plays out. We'll take two more questions before we close for today. The question is, which colorless diamonds are the most attractive in terms of investment, in your opinion? I think I have a feeling that the question was more toward which color diamonds are the most attractive in terms of investment. So I'll try and answer that. We've seen the short answer are the pinks and the blues. That we saw very strong pricing in those two colors in 2018 at the auction, on the auction circuit, is a good gauge for trends in that market, and they're not easy to come by. So I would expect that those rare pinks and blues are which are more rare than other colors, will continue to garner interest amongst the higher end investor. So a final question. Just let me go through some of them, and so what do you think about diamonds on the second-hand market in terms of auctions, and their prices seem to be very soft? I mean, the question is if you're referring to rough or the polished second-hand market, but generally the second-hand market has been a source of is a source of diamond supply, essentially, and manufacturers and polish dealers are interested in those goods to recut them and to fill their inventory, their more specific inventory needs. So that is a dynamic market that we keep an eye on. It says prices seem to be very soft. I think the prices that you see in the auction market to reflect what's going on in the industry as a whole. It's another way of selling diamonds, and people are not prepared to pay more for what they're prepared to, what they think they can ultimately sell the diamond for. So so like I said earlier, the buyers are setting the tone in this market, and I would expect that that is playing out in the auction circuit as well, and I think both on the rough and the polished side. So thank you once again. Thanks for your time and your attention, and I hope the webinar was helpful to you. Again, if you want to ask further questions, I'm available through email or Twitter, and I look forward to our next webinar, which will probably take place in April for the first quarter. I wish everyone a great and successful 2019. I think it's going to be an interesting year, and I hope that it's a profitable one for everyone. So thanks for joining us, and God bless.